Now let's continue with the adjusting entries for accruals. So accruals are made to record the revenues for the services performed but not yet recorded at the statement date. So we have accrual revenues. So accrual revenue, again, it means that we already performed the service, but for some reason, the accountant has not recorded this transaction, or they say that we haven't paid money yet. Okay, so this is an adjusting entry that we need to record. We need to record the services revenues that should be recognized at the day that we prepare the financial statement. And we also have accrual expenses. So accrual expenses means the expenses that already incurred, it's already happened, we already used them, but the accountant has not recorded yet, or we haven't paid money yet. Okay, so these are the concepts of accrual revenues and accrual expenses. As you can see that in chapter 1, we learn about analyzing if transaction, and then chapter 2, we learn about journals, the transaction, pauses to the lecture, prepare the trial balance. And now in chapter 3, we're going to learn about journalize and pause adjusting entry. Adjusting entries means those journal entries that we need to do to make sure that our accounts are correct. And there are two types of adjusting entries that we have, deferrals and accruals. So after we journal and pause adjusting entries, then we will prepare an adjusted trial balance and then the financial statement. Okay, so these are the steps that we're going to learn in chapter 3. Okay, so as I say that accrued revenues means the revenues that we already performed, but we haven't received the money, or the accountant has not recorded yet. Okay, so in this case, the example of accrual revenues includes services, like we already did the service, for the customers, but we haven't received the money yet, okay? Or interest. Interest happen when we already lend the money to somebody. So we earn an interest revenue, but we haven't got the money yet. And drain revenues is happen when you let somebody rent, your house or your building. Service revenue already earned, or we already performed the service, but the customer has not paid you the money yet. So we call it accrual rent revenues. So the adjusting entry to record the accrual rent revenue or accrual interest revenue, or accrual services revenue, is that we're going to debit receivable accounts and credit service revenues. Okay, so debit receivable account. And the receivable accounts, it can be different receivable. So for example, here we can have account receivable. Okay. So if just normal service, we can debit account receivable and credit service revenues. Okay. If it is an interest, okay, like you let somebody lend somebody some money and then you charge them interest. So, for some time you earn the interest, but you haven't received the money yet. So we debit interest receivable and credit interest revenues. Now, this one we also call accrual revenue. So accrual revenue can can have the example of account receivable, debit, and credit service revenue. If it's an interest, we debit interest receivable and credit interest revenues. Okay. Okay, now let's look at the example. In October, Yazici Advertising performed services worth 200 that were not billed to clients on or before October 31. Now remember, October 31, we need to prepare the financial statements at Yazici Company. Okay. And at that time, during October, Yazici Advertising already performed the services about 200. But Yazici has not billed the customer yet. Not billed to customer is mean they has not sent the invoice to the customer yet. But they already performed the service. So at the end of October 31, we need to recognize the service revenues. All right. So the adjusting entry will be debit account receivable 200 and credit service revenue for 200. Why? Because we already performed the services. Okay. Were not billed is mean we haven't sent them the invoice, but we have to recognize the service revenue at the end of October 31. Now, then on November 10, Pioneer receives cash of 200 for the services performed. So what happened when this company, sorry, it should be Yazici, okay, not Pioneer. So Yazici then received money 200 for the services performed on November 10. So the entry for your November 10 will be you got money, right? 200. So we debit cash 200. And customer will not owe you 200 on account receivable anymore because they already pay you. So we're going to credit account receivable 200. Okay. This is related to journal entry on October 31. So now that customer pay Yazici back 200 for the money that they owe Yazici on account receivable. So we debit cash 200, credit account receivable for 200. Okay, so the adjusting entry is debit account receivable 200, service revenue credit 200. Then we pass them to the lecture. All right, so you just understand that when we do the adjusting for accrual revenues, we're going to debit, the receivable account like interest receivable or account receivable, and we credit the revenues account like service revenues, interest revenues, something like that. Yeah. Okay, now let me give you another example for the interest receivable and interest revenue. All right. So let's look at this example. Okay, Kate lends $5,000, 10% per year, and 5 years to Lydia by signing a note on October 1. Okay, so on October 1, what happened? Kate lent money to Lydia. Okay, Lydia gave Kate a note. And this note said that Lydia borrowed $5,000 from Kate. Now, the interest rate is 10% per year, and Lydia promised to pay Kate back in 5 years. Okay, in 5 years. So October 1, right? Kate lent the money. All right, so journal entry on October 1 is that, Kate will have a note receivable of 5,000 and cash credit 5,000, because Kate lent money to Lydia, right? So on October 1, we debit note receivable 5,000 and credit cash for 5,000. Now is December 31. Okay, now it's December 31. There are how many months already that Kate lent the money to Lydia? So we have October, November, and December. So there are 3 months. Okay, there are 3 months. So interest already happened for 3 months. Okay, interest already happened for 3 months. Now, how can we find the 3 months interest? Okay. So the interest is $5,000, 10% per year, right? $5,000, 10% per year. So to find the interest, we take $5,000 times 10% per year, okay? The interest rate on the note is always per year, okay, class? The 10% is always per year. So $5,000 times 10% per year, and that will give you $500 per year. So every year, the interest rate will be $500 per year, okay? And now, if you want to find the interest amount for 3 months, okay? So we're going to take 500 divided by 12. Okay, so 500 divided by 12, and that will give you how much? $41.66 per month, right? And we take this amount of time with 3 months, that will give us 125. Okay, 125 will be for 3 months. So at December 31, Kate company will record the journal entry, the adjusting entry. So Kate will debit interest receivable for 125 because Kate company already earned interest. Okay, they already earned interest revenues for 125, but they haven't received the money yet. So we debit interest receivable for 125, going to receive it later. And interest revenue, we credit 125. This one we call it accrual revenue, okay? This interest revenue, we call it accrual revenues. Revenues already earned is already happened because, we already lend them the money, but we haven't received the money yet. Okay, so we have interest receivable, debit 125, and interest revenue, credit 125. All right. Now let's continue with the accrual expenses. Accrual expenses show the expenses that incurred but not yet paid in cash or recorded. So it can happen for accrual rent expenses. Okay, accrual rent expenses has happened. It means we use the rent, okay, already. We use the rent already. This is opposite with accrual revenue, yeah. We use the rent already, but we haven't paid money yet, okay. We use interest already. It means we already borrow money, but we haven't paid money yet. Or taxes, or salary and wages expense. Okay, so there are many different kinds of accrual expenses. Okay, so what happened is that when we already use the service from another company, or when we already use the expenses, we have to record them. Okay, even though we haven't paid money yet. So the journal entry to record them is that you're going to debit the expense account and you're going to credit the liability account because we owe the money to somebody, okay? We already used the expense, but we haven't paid money yet. We owe money to someone. So We debit expense account and credit liability account. All right, now let's look at this example. Yazigi signed a 3-month note payable in the amount of $5,000 on October 1. The note requires Yazigi to pay interest at an annual rate of 12%. Okay. So on October 1, right, Yazigi borrowed money, okay, on a note. So on October 1, remember, we did record the journal entry that we debit cash 5,000, we borrow money, and we credit notes payable for 5,000 on October 1. All right? Now is October 31. So 1 month already passed. Okay, after Yazigi borrowed money, 1 month already gone. So Yazigi interest expense already incurred. Okay, because you already borrow money, so there will be an interest expense. And Yazigi has not paid the interest yet. Okay, so at the end of October 31, you will need to record the interest expense that already incurred but has not paid yet. So we take 5,000 times 12%. Okay, that will give you how much interest per year. Okay, 5,000 times 12%, that will give you how much interest per year. And so we times 1/12 because we only borrow 1 month. So that will give you interest expense of 50. Okay, interest expense of 50. So the journal entry is that we're going to debit interest expense 50 and credit interest payable 50 because we already borrow for 1 month. So interest expense already incurred. It's already happened, but we haven't paid money yet. So we credit interest payable. Okay, interest payable. Now this is opposite to when we lend the money, yeah, class? When we lend the money, then we will debit interest receivable and credit interest revenue, remember that? But when we borrow money, we will debit interest expense and credit interest payable. Now let's look at the journal entry just now about Kate Company. You remember? Kate lent the money to Lydia, right? So we debit interest receivable and interest revenues, 120 for 3 months. So what about for Lydia companies? What will Lydia company record the journal entry, adjusting entry on December 31? Remember, Lydia borrowed money from Kat, right? So on December 31, Lydia also should recognize that there is an interest expense for 3 months, 125, and she has not paid the money yet. She still owes the money to Kate company. So for Lydia company, we will debit interest expense 125 and credit interest revenue for interest payable for 125. Okay, debit interest expense 125, credit interest payable 125. All right, so this is about the accrual expenses. Okay, debit interest expense 125 and credit interest payable. Now let's look at another example. On January 1, the company B borrowed money from company A by giving a note to company A. Okay, 10,000, 5% per year, and this will be for 5 years. So B borrow money from A. How much? $10,000. Interest rate 5% per year, and it will be for 5 years. Okay. Now is remember that company B has to pay interest to company A, right? Because borrow money from company A on a note. So on December 31, 1 year already happened. Okay, 1 year already happened. So company B will owe the interest to company A for 1 year. So interest expense incurred, but company B has not paid money yet to company A. Okay, so we will have accrual expense, right? Accrual interest expense. So let's calculate the interest for 1 year. So we take $10,000, we times 5% per year. Okay, and that will give us interest for 1 year, right? And then we're going to record this interest for 1 year. So how much is that? It's going to be 500. Okay, so we debit interest expense 500 and we credit interest payable for 500. All right, now let's go to another accrual expenses we have is accrual salary. Okay, so for accrual salary, we're going to debit the salary and wages expense and credit salary and wages payable. Okay, debit salary and wages expense and credit salary and wages payable. All right, now let's look at the example here. Yazici advertising pay salary and wages expense on October 26. The next payment of salary will not occur until November 9. The employees received the total salary of $2,000 for a 5-day work week or $400 per day. Okay, so remember, Yazici company, they hire employees, right? And the employees start to work for them on October 15. Okay, they pay the salary on October 26. October 26 is the day that they pay the salary. And the next day that they're going to pay the salary will be on November 9. Okay, November 9. Now remember, we are now at October 31, right? We are now at October 31. We're going to prepare the financial statement of October 31. So we have to make any adjusting to the accounts at October 31. So you can see that the last day we paid to the employees on 26. Okay, for the 2 weeks that they work from 15, right? 15, 16, 17, 18, 19, then 22, 23, 24, 25, 26. Okay, so they pay the salary on 26 for the 2 weeks that the employees work for them. All right, now we are at October 31. How many days that the employees already work for us, but we haven't paid money to them yet? So you can see that there are 3 days, right? 29, 30, and 31. 3 days that the employees already worked for Yazici company, but Yazici has not paid money to them yet. Okay, 3 days. So this is called accrual salary and wages expense. All right. So expenses already incurred because the worker already worked for us, but the company has not paid to them yet. We call it accrual expenses. Okay, accrual expenses mean expenses already incurred, but the company has not paid money yet. So 3 days, okay? And remember the salary is 400 per day. So for 3 days, so we take 400 times 3, that will give us 1,200. So the adjusting entries will be debit salary and wages expense, 1,200, and we credit salary and wages payable, 1,200. And then we post them to the lecture, okay? Debit salary and wages expense, 1,200. credit salary and wages payable, 1,200. All right, so you remember for accrual expenses, we will debit the expenses account, all right, like interest expense, rent expense, salary and wages expense, and we will credit liability account. Liability account will be interest payable, rent payable, salary and wages payable, all right? Sorry, class, this one you have to correct. This one is accrual expenses, not accrual revenues, okay? Accrual expenses. All right, so these are all the adjusting entry of chapter 3. So let's review again. Adjusting entry for chapter 3, there are two types of adjusting entries we have, deferrals and accruals. Deferral include prepaid expenses, right? So when we use the expenses that we already prepaid previously, the adjusting entry for prepaid expenses is that we will debit expense and credit prepaid expenses. Okay, it can be insurance expense, debit prepaid insurance, or rent expense, debit prepaid rent credit. Okay, now and then adjusting entry for supplies will be when we use the supplies, we will debit supply expense and credit supplies. Okay. Adjusting entry for depreciation will be debit depreciation expense and credit accumulated depreciation. Here the blank you can feel like accumulated depreciation for building, equipment, or machine. How about adjusting for unearned services revenues? Remember, last time we got the money before we provide the service. Now, when we already perform the service, we will make adjusting entry by debit unearned service revenue and credit service revenues. Okay, now let's look at accruals. For accruals, we have two types, accrual revenues and accrual expenses. Accrual revenues, okay, it happens when you already performed the service, but you haven't received the money yet. So we will debit receivable account and credit revenues. So if you already performed the general service, you can debit account receivable and credit service revenues. Okay, now if you lend the money to somebody, and for some time interest already earned, but you haven't received the money yet, so you will debit interest receivable, credit interest revenues. Okay. All right, now let's look at accrual expenses. Accrual expenses means expenses already incurred, but we haven't paid money yet. So we will debit expense account and credit payable account. Okay, example, salary and wages expense. If the employees already work for you, you remember just the example just now for 3 days and you haven't paid the money yet. So we will debit salary and wages expense and credit salary and wages payable. And if you borrow money from someone, okay, after some time, interest expense already incurred. And if you haven't paid money yet, we have interest payable. So we debit interest expense and credit interest payable. Okay, so these are the adjusting entry that we have learned. Now, after we prepare adjusting entry, what would be the next step? Remember, we will post them into the lectures. Okay, we post them into the lectures. And then after we post them into the lecture, we're going to prepare an adjusted trial balance, okay? We're going to prepare an adjusted trial balance. So the adjusted trial balance, we will do it after we prepare adjusting entry and after they are posted. And the adjusted trial balance will help to prove that the total debit equal to total credit after you make adjusting entries. And it's very necessary before we prepare the financial statements. So this is how your adjusted trial balance look like. So we have, assets account like cash, account receivable, supply, prepaid, insurance, equipment, accumulated depreciation. Now, accumulated depreciation, remember, is assets, yeah, it's contract assets account. And then we have liability account, note payable, account payable, unearned service revenue, salary and wages payable, interest payable. These are all your liability. And then we have owner's equity account, like capital, drawing, service revenue, all the expenses. Okay. Now, the red color that you see is that the account that we make adjustments. So these are the new balance. Okay. The new balance after we make adjustment. All right. And then at the end, your total debit should be equal to total credit. All right. This is called adjusted trial balance. And then from the adjusted trial balance, we're going to use the number there to prepare the financial statement. So we use the number there to prepare income statement. After we prepare income statement, we will get the net income there, and we use it to prepare the owner's equity statement. After we prepare the owner's equity statement, and we use the owner's capital to prepare the statement of financial position. Okay. So you can see here, all right, this is my adjusted trial balance. So I'm going to use the revenue and expenses, the balance in this trial balance to prepare income statement. And then from the income statement, I will get the net income here, okay, to put on the owner's equity statement. And then I'll prepare owner's equity statement again. And from the adjusted trial balance, I will use all the assets liability account to prepare, statement of financial position and make sure that total assets equal to total liability plus owner equity should be equal, balance. All right, so this is about accrual revenue clip. So in the next clip, I will show you the different treatment for adjusting entry. Okay.